Amidst all this conversation around AI and disruptions, and right when we are hitting the belly of the AI summit in India, we have a very important voice from the tech industry talking to us on all matters pertaining to AI and the disruptions that it may or may not cause, or may cause but may not upend models maybe. Nitin, Rakesh, CEO of Mphasis, who usually, or I would say almost always, calls a spade, joins in right now to talk about that. Nitin, great having you. Thanks so much for taking the time out. And I've been walking to do this conversation for the last maybe 10, 15 days, ever since Anthropic and Palantir conversations came into being and started creating havoc on the bourses when it came to tech stocks. I'm trying to understand this, Nitin. We know that AI is a force to reckon with. It's clear and present, quote unquote, danger. How big a danger to existing business models of the IT services firms? I'm starting off with the micro right now.
I think, Neeraj, firstly, thank you for having me. And I think it's quite topical. I mean, in a way, it's good we ended up today because of the AI summit going on. So I think it all works out in the end. I think the way to think about AI and the impact that AI is going to have or is having on not just tech services, but more broadly in across the economy. Let's first get it right. It's a set of very powerful new capabilities and tools that have been built, especially over the last 3 or 4 years since we saw the launch of LLMs and GPT-4. That you cannot deny, and I think the pace of adoption, the pace of evolution and change is obviously accelerating as well, to a point that 4.0 is not now obsolete. So I think from that perspective, it's truly amazing to see that we've gotten to this point and we have the ability to inference and summarize and do what typically would take us days or weeks to do. We can do that in a matter of hours, if not even lesser. But let's not confuse the ability to demonstrate with the ability to accept accountability, because all of this works great in a greenfield environment. What I mean by that is, if you're building something afresh, yes, you can, your development timelines will shrink. You have the ability to work with AI agents that can code, AI agents that can, do business analysis, summarizations. But that's not the world of enterprise IT. The world of enterprise IT is really what we call Brownfield, because it's got tech stacks from the last 75 years, still operating many cores, still running many enterprises, supply chains, GLs. I don't think we can assume that a tool by itself is going to disrupt how enterprises consume tech, and more importantly, who makes it actually happen for them in reality, and that's the industry that we represent. So I think it's a little bit of a simplistic, view when you start thinking about the fact that these tools can disrupt an entire industry that actually makes the real, enterprise tick and work. So I'm in the camp that, it's great that we have all these capabilities. We should focus as an industry on how do we bring it to life for an enterprise? How do we get the data pipelines, the governance, traceability, auditability, reliability, security set up? And more importantly, how do we make sure that there are business outcomes that can be aligned? Having said that, in every business, including ours, especially because, end of the day, we are a reflection of enterprise tech consumption. If we stand still, we're going to actually go obsolete very, very quickly, especially with the pace of change that we are in. So few things will have to change, whether it is how we think about the business model, what do we stand for when it comes to delivering, what are we delivering, how are we delivering it, what ingredients are we using, is it just people, or are we deploying tech in the solutions we are taking to the customers? So I think the bigger question really is not whether the industry will survive. The bigger question is who's making the right moves, who has the right ability to pivot fast, and in a way, stay ahead of the 8 ball when it comes to taking those propositions to the customer.
So Nitin, how are you thinking about it right now in terms of the changes that you need to make to Mphasis, which is a large organization catering to large enterprise? And are these moves a combination of people plus maybe AI agents or tools or enabling companies to adopt that? Isn't it top line deflationary?
So Neeraj, I think, as I mentioned, right, if you stand still, absolutely, you will see deflation on the top line. You will see pressure on the bottom line, because clients are expecting you to give them the benefits of AI, and in many cases, take on the risk of actually delivering those benefits in terms of making them real. But if you truly play this out right, I think we're moving from, and I've said this at least for the last 2 years, that we are moving from a people-based, labor-based services model to a model that is a combination of people and software. We are no longer in the labor arbitrage business. We are in the tech arbitrage business. The ability to orchestrate, architect, and design solutions is something that AI cannot do on its own. Then the ability to make those solutions real inside of a brownfield enterprise is not something AI can do on its own either. So the focus for us has been at Mphasis. We've actually taken a very, very big view of where we are heading. We started by building tribes, points of views, reference architectures, codified them. And about 6 months ago, we actually formally launched a platform called Neo IP, which really brings all of these capabilities together for enterprises to be able to do this, whether it's building the AI superhighway or the fabric that will help them consume AI at scale, or whether it's modernizing your data pipelines, modernizing legacy applications, because that becomes the biggest impediment given all your core data and systems are locked because of legacy. So it's a number of propositions, but the approach really is very much aligned to what you said, which is a combination of using people, because you will always need people. They have the context, they have the engineering skills, and then of course deploying the right set of software tools, whether our own or tools like Anthropic.
So Nitin, a simple question would be then, you hinting towards newer outcomes for clients, right? Can the value of growth in newer outcomes, and this is not just for Mphasis, but for the industry, can the volume of newer outcomes grow fast enough to replace the loss of revenue from billable hours model? Can it?
Yeah, I think the short answer is you have to look at where the tech spend is going. Because as I said, right, our industry is a reflection of enterprise tech consumption. If you look at the biggest banks, they're actually spending more in tech in 26 than they did in 25. They spend more in 25 than they did in 24. I haven't come across any customer, barring maybe somebody who's hit badly by tariffs or, trade issues that are going on between US and Canada or US and Europe. I haven't come across any customer who's basically saying, I am going to take a view that because AI can do A, B, and C, I'm actually going to reduce the spend I have on tech. If anything, they're trying to repurpose the spend into more transformation client-facing areas. So this whole wave of front-to-back transformation that started with the digital era will get accelerated. And hence, again, just like in financial markets, you follow the smart money, you have a chance of actually making good returns. In our business, you follow where the investment will go, and you will always find the addressable market to be ready and available. If you stand still, then you won't, right? As an example, if you have a very large run book where you're doing production assurance, infrastructure services, remote infra management, service desk, that will get identified very quickly. We've seen that happen to contact centers. We've seen that happen to many businesses that provided people-based services on a billable hour basis. But if you have the ability to deploy agentic tech and you dovetail application development and maintenance and you look at the whole SDLC transformation, you can become a partner of choice for the customer because they will write more software, right? We entered the software eating the world phase 15 years ago. We haven't exited it. If anything, is going, software will eat now software and the world. So I think the excitement that I have comes from the fact that if anything, tech is becoming even more integral to every enterprise, not less.
Nitin, what is then how do I say, the moat for an industry, which is, let's say, the Indian IT service industry at large, or maybe not just India, but companies global as well, which had this IT service model, because the people knowledge, the engineering skills were the moat. Now, if the offering is built on top of a service or a LLM which is provided by somebody else, then almost anybody else could do that work as well, presumably. So is there a moat and therefore an ability to charge, or does that dissipate over time?
So there are three things that you need to think about, right? Yes, end of the day, an LLM is also a tool.
Yes.
Right? There have been, for the last 50 years, we've seen new tools come up, right? Internet was a massive enabler. Digital tech, cloud, CI/CD pipelines have been around for the longest time. We've seen massive breakthroughs with machine learning. All of these are tools that are available. Because I'm using a tool doesn't dissipate my moat. My moat comes from understanding the client domain and the context. Our moat comes from the ability to actually make it real inside of the client context. And more importantly, if you accelerate on top of that with a set of platforms that we are actually investing in, because we are trying to codify a lot of the services that we used to do with people into a set of platforms that can be deployed for reusability, scalability, efficiency, and bringing together a secure framework to deploy a lot of these new tools that are coming about. So I think the moat will come from a combination of domain, context, and IP that you build. And the more, it is an ecosystem play. We have been, and we will continue to play with the hyperscalers, the LLM providers, just like we've demonstrated as an industry the ability to play with the large cloud providers. Remember, cloud was disruptive to data center businesses, right? But it led to a whole new wave of revenue that was created out of writing new software and making sure that the old software works in the cloud environments. I think we are. This is a little bit bigger. This is a little bit faster, but contextually, we are not in a model where our moat will disappear because we are using third-party tools.
Got it. Nitin, can I make it slightly simple for my understanding and maybe the understanding of a few of the viewers? If
Sure.
an Mphasis, or forget you right now, but the industry-wide, if there was an offering of a bouquet of offerings, which could be, ERP, BPO, etc., a multitude of segments that were being offered by a typical IT service offering, maybe 5 years ago, 4 years ago, maybe 10 years ago, maybe 2 years ago. And now when you're going with a new offering, which is, agentic AI plus the understanding that an IT firm would have, is there a change in the billability from the client for that offering? Something that may come on top of it is separate, but is there a change in the billability or is there not?
So, Neeraj, the short answer is yes, there is, because what we deliver is changing, how we deliver it is changing, how we solution it is changing, what tools we deploy is definitely going to change. We can't fight that. We have to just embrace it. I'll give you two examples. If you think about production support, right, application maintenance, L0, L1, L2 help desk, all of these were or still are many cases managed services, fixed price models, but the payment mechanism was per incident. That model is shifting very, very quickly to availability or a fixed fee, because we don't want to be in a model where we are letting an incident happen. We are going further left and shifting left and saying, let's go predict an incident. Let's use big data and machine learning to do predictive analytics. Then let's use LLMs to do preventive fixes, because we can train an AI agent to do the fix before it becomes an incident. In that case, you can't get paid for the incident, but you can either get paid a flat fee or you can get paid for what we call availability. So the billing model will change. The client may pay less, but a lot of that money is going to get redirected into writing new software, modernizing applications. And hence, again, we've talked about these concepts that you move the operating cost, the run cost into the change cost. So the run the business spend will go into the change the business spend, and effectively you're creating new TAM while the client spend may or may not even actually go up. So I think the ability to drive efficiency will mean that the billing model might change, and that's progress. We've seen that happen in the digital era, where 30 to 40% of application development used to be testing. It's probably less than 10% today, and that's the law of this business, right? You evolve, you adopt new tech, and you deliver things differently.
Okay. Think 2028, maybe 2029, or you might argue that Neeraj think 2027. But what are the capabilities that an IT service firm, which doesn't own these LLMs, right, is building or has, which a client, which a Palantir or an Anthropic cannot disintermediate from a company like Nitin?
So I think if you think about, and without necessarily getting into the business model of some of the other firms, but if you think about an enterprise environment, I think it's very important to understand the difference between greenfield and brownfield. A lot of the greenfield work looks very, very appealing, because you can demonstrate capability in a greenfield environment. You can do a project in a lab and say, I can now do underwriting with 20%, 30% less people, or I can do claims processing where you can eliminate 70% of the staff. But when you start talking about brownfield, again, domain, context, and platforms really matter. And finally, taking accountability over just having tools is really the biggest difference for an enterprise. So we can't look at the world outside in and say these tools are great. They work. They may help maybe new companies. They may help the mid market or the smaller companies, because they never had the budgets, so they can now do more with less. But effectively, the ability to orchestrate that tech inside of an enterprise is the biggest moat. And the most complex engineering problems that were probably getting pushed aside, for example, legacy modernization, we've looked at it for years. It used to be complex. core systems transformation, ERP transformations, ERP migrations, we can now start attacking those problems because we have these powerful tools that actually take not just the cost and time out, but they take the risk out. So I think to me, the ability to open new markets that were too complex or too hairy for customers to undertake, new segments within the spend will definitely be there. The one last thing I'll make is whenever there is a pivot, and we've seen this in the last two cycles with the internet and digital, I think it's a very risky strategy for investors to look at the whole sector, and it's hard not to, but you have to figure out which companies are making the right investments and which companies have the right ability to be on the winning side of this trade.
And therefore,
That's the thing that it's become. You started with the micro. This is where I would say micro matters the most.
amazing. And my last question to you is to Nitin Rakesh, the CEO of Mphasis, but also somebody who's run an asset management firm and been in financial services. But just before that, Nitin, so what you're effectively telling me is that could it happen that a large firm which depended heavily on ERP in the past can still kind of adapt to this, or will it be difficult? Will an elephant be able to dance? Or will it be actually advantage companies with a smaller legacy book? What do you think?
Yeah, I think size, in a way, is an impediment, but that doesn't mean that you can't dance if you're an elephant, right? We've seen, I mean, look at IBM. 100 years in, I mean, it's a company we all, I really admire. And I think what Arvind's done with IBM is amazing because he's pivoted the whole company to basically software and AI software, right? So, I mean, Elephants Can Dance was a book written by an ex-IBM CEO, right? So there's definitely something going on there. So I don't think it's out of the realm of possibility that, just because you're big, you won't be able to pivot, but you have to make the right investments. And I think this is the time, this is the one message that I have, for our industry colleagues as well, that if we don't invest in the right set of capabilities and not just people, but IP assets, maybe buying some capability and competency, that I think will be needed for us as an industry to accelerate this pivot.
Got it. Nitin, one last question. Because you've headed an AMC before as well, for IT service companies' valuations, right? The stability of the cash flow with the billable hours model was fabulous. It gave a higher multiple to these companies, right? All through. Now, some companies have changed, some companies haven't, some companies are changing. But if indeed the share of the ERP and the legacy work is very high, when in trying to pivot, that revenue model or that cash flow kind of comes off, does it hit valuations? Now, please don the hat of an AMC guy. It was many years ago, but I'm urging you to do that. Will it hurt the valuation multiples?
So, Neeraj, in the short run, because of the volatility, uncertainty, fear of the unknown, new, it's definitely going to put some pressure on investor psyche. And whether we like it or not, investing is a psychological as well as a scientific process. I think it's up to us as an industry to give that, predictability and repeatability of earnings, cash flow, and growth. I don't think at heart the model is going to move too far away from, all the merits that we've seen. We are long dollar always because revenues are in dollars. There's a natural hedge. We have the ability to generate high free cash flows. We have the ability to invest. We effectively have very, very healthy balance sheets. None of that is changing in the short or medium term. I mean, forget long term. I don't think ERP is going away either. I don't think of any enterprise that will wake up tomorrow and say, I'm going to get rid of my SAP or Oracle, core platforms. So the only variable will be growth rates, and that will vary by company.
Nitin, I'm going to ask you, I know I'm making it a habit of asking you one last question, but it's just that we don't get to talk too much. And I know it's very late for you, but I'm going to ask you maybe one final question. Might be a difficult one for you to answer. So I'll agree I'll understand if you don't want to. But do you reckon when you look industry-wide, I'm not asking you to put names here, but when you look industry-wide, that the IT service companies, by and large, India, globally, etc., are making this pivot fast enough to be as relevant as they are right now, 3 years, 4 years hence, or are there is the rate of change slow out there because it's very easy to like the billable hours cash flow?
Yeah, I think again, Neeraj, each company will have to find its own North Star strategic approach. In general, there will be some common elements, but it varies by your portfolio, industries you operate in, geographies you operate.
Nitin, but that's an answer that you've given me. I'm now trying to ask you whether you believe companies are doing it. Acha, okay, fine.
I haven't finished the answer, right?
Sorry.
So, very broadly speaking, I think there's a lot being done. I have a lot of respect for this industry because we've been written off at least a couple of times before, right? And I will go back to what I said earlier. I don't think you will be able to see every company come out of this on the right side. So there will be some that will probably not have done enough, and will probably see headwinds for a period of time. And we've seen many examples of that, even in the top 20, top 10, top 20 names in our industry. So it all again goes back to understanding what is needed to be done, evolving an evaluation process for saying, okay, these are the signs that I'm going to look for. Are you making enough investment in IP? Are you making enough investment in capability? Are you actually showing deal wins? Are those deal wins delivering the right outcomes for customers? And more importantly, if we play this right, 2 years out, we should have operating leverage that is better than what we have today. Because remember, today's model is very linear. To grow 10%, or rather, yesterday's model was very linear. To grow 10%, you need to grow headcount by 8% or 11%, depending on where you add people. If you get that nonlinearity going, we probably could be in a really sweet spot, and the multiples might even expand for companies that are able to show that kind of growth with that kind of operating leverage.
Lovely talking to you as always, Nitin, Rakesh. Thank you so much for taking the time out and giving us a great gist of what is currently happening. Really appreciate your time.
Thank you for having me.
The pleasure was ours.